your shortcut to financial literacy, Accounting in an Hour, with you today. We'd be happy to field questions at the end of the course. In the meantime, you may write in your questions by selecting the Q&A tab at the top of your screen. To jump right in, a company's financial position can be summarized in two very simple financial statements, the income statement and the balance sheet. The income statement simply shows how much money you make over a period of time, and the balance sheet shows what you have and what you owe at a specific point in time. Starting with the income statement. The income statement is commonly called the P&L, or profit and loss statement. It shows how much money you make, how much money you spend, and what's left over, your profit and loss, and it always governs a period of time. The first component of the income statement is revenue. Revenue is the money you receive before you pay any of your expenses. Revenue can come from selling products, services, or sources like rent from an apartment building. We're going to use an example of Jackie's hardware store because it's a fairly simple way to explain how these concepts fit in practical application. In Jackie's hardware store, she derives revenue from the sale of such things as hammers, saws, nails, ladders, and so forth. If she sells each hammer for $10 and in the course of the year sells 1,000 hammers, she's received $10,000 in revenue for hammers. If she sells 2,000 saws at $20 each, that's $40,000 in revenue from saws. If you add the revenue from the hammers to the revenue from the saws to the revenue of all the other products she sells in her hardware store, we will assume that last year she derived total revenue of $1 million. The next component of the income statement is direct costs. These are costs which are directly attributable to the generation of revenue. Things like commissions, which are not paid unless revenue is generated. There is also the cost of the goods that are sold when the revenue is created. In Jackie's case, because she does not pay commissions, her direct costs are exclusively the cost of the inventory that she sells when she generates revenue. For example, the cost of the hammers and the cost of the saws. For example, if her cost of hammers is $5 and she sells 1,000 per year, her total direct cost associated with the sale of hammers is $5,000. Similarly, if her direct costs related to saws is $10 each and she sells 2,000, her direct costs related to saws is $20,000. If we add the cost of her hammers and saws to all of her direct costs for the year, we're going to assume that her total direct costs last year were $500,000. The difference between revenue and direct costs is gross profit. On a single item, the gross profit on a hammer would be $10 in revenue minus $5 of direct cost equals $5. On saws, she receives $20 each and pays $10 each, so her gross profit is $10. We're going to assume revenue was $1 million last year and that her total direct costs were $500,000, so that her gross profit for all of last year was $500,000, leaving her with a gross margin of 50%. Gross margin is simply gross profit divided by revenue. It is from her gross profit that she must pay her operating expenses. Operating expenses are incurred regardless of whether or not any goods are sold. Operating expenses might include payroll to non-commissioned employees, might include rent, utilities, and so forth. Jackie's biggest operating cost is her payroll, which is about $120,000 a year. In addition to that, she pays $20,000 a year in advertising and $10,000 a year each for utilities and insurance. We're going to assume that all of Jackie's operating costs for last year totaled $300,000. Fortunately, her gross profit of $500,000 was more than sufficient to pay her operating expenses, leaving her with an operating profit of $200,000. Operating profit is simply gross profit minus operating expenses. Operating profit must then be used for non-operating expenses, including interest expense. Interest expense, as most of us know, is the cost of borrowing money. Whether you are borrowing money on a credit card, mortgage, or an equipment loan, it is the cost of having someone give you a loan. In Jackie's case, her only interest expense is related to the mortgage that she has on her building. The mortgage is in the amount of $900,000, and she pays 10% interest. So her interest expense last year was $90,000. From her operating profit of $200,000, she must cover her interest expense of $90,000, leaving her with pre-tax income of $110,000. Unfortunately, when you are successful and profitable, you must pay taxes. Since she has $110,000 of pre-tax income, assuming a 30% tax rate, she would have to pay $33,000 in income taxes, leaving her with $77,000 of net income or net profit. Net income is simply operating profit less any non-operating expenses such as interest or taxes. To summarize the income statement, you start with revenue, all the money received before paying expenses, less direct costs, those expenses which are directly associated with the generation of revenue, equaling gross profit. From gross profit, we pay our operating costs, which are expenses that are incurred regardless of whether or not any revenue is generated, equaling operating profit. From operating profit, we pay interest expense and taxes and any other non-operating expenses, leaving us with net income. Once again, it's very important to note that the income statement governs a period of time. How much money did you make last week, last quarter, or last year? Moving on to the even simpler financial statement, which describes a company's financial position, the balance sheet. The balance sheet talks about what a company's assets are, what it owns, what it owes in the form of liabilities, and what's left over in the form of net worth or equity. The balance sheet, as the name implies, seeks a balance between assets which always equal liabilities plus net worth. And if you learn anything today, please take this example with you. A perfect example of the balance sheet is the purchase of a house for $100,000. You borrow $90,000 in the form of a mortgage. You put down $10,000 in the form of equity or down payment to buy the $100,000 house. The $100,000 asset, the house, equals a $90,000 liability, the mortgage, plus $10,000 of equity or down payment. Similarly, there are various components to a balance sheet, the first of which is assets. Assets are simply things a company owns. Assets may be classified as short-term or long-term. Short-term assets are those which are expected to be converted into or used as cash within 1 year. Long-term assets are those assets which are not expected to be converted into cash within 1 year and are generally used to operate the business. Common types of short-term assets include cash, receivables or money that your customers owe you, inventory, and prepaid expenses. Long-term assets include things that the business needs to operate, such as furniture, fixtures, equipment, a building. Intangible assets are those assets which you can't touch or feel. Intangible assets include such things as patents, trademarks, copyrights, or developed technology. At the end of last year, Jackie's Hardware Store had assets of $1.8 million, composed of $300,000 of short-term assets and $1.5 million of long-term assets. Her short-term assets were $100,000 of cash, $50,000 of receivables, and $150,000 of inventory. Her long-term assets were composed of $200,000 of equipment, $200,000 in furniture and fixtures, and $1.1 million in real estate and related improvements. Moving on to liabilities. Liabilities are simply things that a company owes. You can owe money in the form of taxes to the government. You can owe money to your employees in the form of payroll. You can owe money to your vendors in the form of payables. Short-term liabilities are those liabilities which must be paid within 1 year. Long-term liabilities needn't be paid for at least a year. Short-term liabilities include payables. When a vendor ships you a shipment of hammers, for example, with an invoice and expects to be paid in 30 days, that is an obligation or liability of the company. There are other short-term liabilities, including things like accrued expenses. Accrued expenses are incurred regardless of receiving a specific invoice. For example, if Jackie pays her payroll once a week on Friday, and she were asked what her balance sheet looked like on Tuesday, there would be 3 days of accrued payroll expense that she still owes her employee, but hasn't been billed for the portion of payroll that has been accrued. Another accrued liability example would be employee vacation. In addition to payables and accrued expenses, the portion of long-term debt, which is due within 1 year, is also considered a short-term liability. As we mentioned, long-term liabilities are those debts which don't need to be paid for at least a year. It's important to note that repayment of debt or principal is separate from the payment of interest. Long-term liabilities include equipment loans and real estate mortgages. In Jackie's case, her liabilities at the end of last year totaled $1 million, composed of $100,000 in short-term liabilities, $50,000 of which were attributable to accrued expenses and $50,000 of which were attributable to payables, plus the $900,000 mortgage on her building. The difference between assets and liabilities is net worth. Net worth effectively means if you were to take the assets and sell them for book value and use the proceeds to pay off the liabilities, what's left over? Keeping in mind assets' book value may often differ from market value, but we'll get into that shortly. So Jackie's net worth at the end of last year, since she has $1.8 million in assets and $1 million in liabilities, was $800,000. To summarize the income statement and balance sheet again, the income statement tracks revenue, expenses, and profit or loss over a period of time. The balance sheet shows what your assets, liabilities, and net worth are at a specific point in time. It's important to note that not everything you buy is an expense immediately. Something is considered an expense when the value is lost. I'll give you an example. If you pay rent for a month and that month expires, there's no remaining value. It's been purged. When you buy inventory, however, you haven't used up the value. You've effectively transferred one asset, cash, into another asset, inventory. It's only when that inventory is sold and that hammer walks out of the hardware store that the value is lost. As a result of that value being lost, that item in inventory is, at that point, expensed. In addition, cash balances change for a variety of reasons other than net income. You might think that since Jackie had net income last year of $77,000, that her cash balances would increase by $77,000. But that's not necessarily the case. For example, she may have paid down debt with that money. She also may have received money in the form of a receivable that was owed to her by a customer, but for which she has not yet gotten paid. So the bottom line is, you have to factor in changes in asset levels through the balance sheet in conjunction with the income statement in order to get a full picture of a company's financial health.
Hi, we seem to have lost you here. Are you still there?
Yeah, I'm still here.
Yep. Hi, Rick.
Review, yes, I'm here.
Hi, okay. You're at review right now?
Yes.
Okay, there you go.
Number one, an income statement shows how many assets a company has and what it owes at a given time. The answer is false. That describes a balance sheet. Two, both an income statement and balance sheet show how much money a company has made or lost over a period of time. False. The answer is false. That describes an income statement only. Moving on to accounting principles. There are two kinds of accounting. The first of which is very straightforward and simple. It's called cash accounting. When you receive cash, you've got revenue. When the cash goes out of your account, you've got an expense. That's basically it. Accrual-based accounting, upon which this course is based because it's more accurate, is the process of recording or booking revenue when items are delivered to your customer. You may have shipped $1 million worth of product to customers and not yet gotten paid. In cash-based accounting, the accounts receivable doesn't exist. It is also the process of recording expenses at such time as invoices are received from a vendor. You might get a bill from the electric company and not yet paid it. Accrual-based accounting recognizes that liability. Cash-based accounting does not recognize payables. In accrual-based accounting, you can have a pile of IOUs on your desk, bills from your suppliers which haven't been paid. Since the money has not gone out of your account, cash-based accounting does not recognize it. Accrual-based accounting creates an entry to recognize a liability when a bill is received, or recognize a receivable asset when an invoice is sent to a customer. It gives a much more accurate picture as to how well the company is doing. Small company owners tend to favor cash-based accounting because it gives them more flexibility with regard to minimizing and deferring tax obligations. For example, a small business owner might have a potential taxable gain for the year. So in December, he or she may write additional checks to prepay the insurance for the next year or to prepay rent for the first few months of the following year, and they get some checks from customers and not deposit them until January. So they accelerate their expenses and slow down their revenue in order to minimize or defer taxes. Now, while this is aggressive, and we certainly don't condone it, it is important to note that it is a standard practice in many small businesses. Large public companies, on the other hand, for which you may purchase shares which are tradable on an exchange by phoning your broker, like General Electric, Microsoft, and IBM, are required to use what is called GAAP accounting. GAAP stands for Generally Accepted Accounting Principles, which is based on the accrual method as we discussed. Public companies have a different motivation. Their motivation is to maximize shareholder value by growing earnings per share. Public directors are required to follow that mantra. So public companies, on the other hand, very often try to accelerate revenue and minimize expenses in order to show the maximum possible earnings that they can in order to meet or exceed Wall Street's short-term earnings expectations, even though this process may be tax inefficient. Moving on to working capital and liquidity. As we mentioned, the fact that a company may generate net income does not necessarily mean that cash balances have increased by the amount earned. In fact, companies that are growing while extending payment terms to their customers may see substantial paper profits at the same time cash is declining. For example, if I'm a sweater manufacturer and I get a big order from Macy's department stores, I'm delighted. However, I have to pay for a salesman to attend a trade show to get the order. I have to buy my wool and my thread, pay my payroll, put the sweaters together, service the machines, finish the order, pay for shipping, and then Macy's receives it along with the invoice. I'm out of pocket a lot of money. But Macy's still doesn't pay me for maybe 30, 60, or 90 days. A lot of these problems are very common with small businesses, and they're often not anticipated because small business owners start by putting together projections on what they expect to make and how long it will take them to become profitable without considering the balance sheet implications. The fact that you are profitable does not mean that the business is going to generate sufficient cash to pay for your operations. While you may be profitable in 6 months, it may take you 9 months or a year for the company to finally catch up. Some solutions to this problem include quick pay discounts. If I say to Macy's, look, if you pay me within 10 days, I'll give you a 2 or 3% discount. Motivate your customers to pay you more quickly. Receivable factoring. To the extent that Macy's owes me $1 million, I can go to a receivables factor that will buy or loan against my receivables. It may be expensive to do so, but at the same time, it bails me out and perhaps puts money in my pocket that enables me to pay my employees and possibly fulfill another large order to Nordstrom. I would not be able to take that additional business if I didn't take 6% off the top to the receivables factor to get paid more quickly. And lastly, vendor financing. If Macy's is going to make me wait, I'm going to ask my suppliers to wait along with me. The supplier of the wool wants to get paid quickly, but I'll say, look, if you want my business, you're going to have to wait 90 days or more to be paid. This way you buy a little breathing room. As we mentioned earlier, asset values on a balance sheet often differ from their market value. Typically, assets are stated on the balance sheet at their original cost. If you buy a car, for example, it's not going to retain the same value 2 years from now as the price that you pay for it now. On the other hand, a building that you buy might even appreciate in value over time. So there are various reasons why the market value of assets may be different than the book value. All long-term assets have a limited useful life. Whether you're buying a building, which has a very long useful life, or you're buying a piece of machinery, which has a shorter useful life. A building might have an estimated useful life of 39 years, while a computer might have an estimated useful life of 5 years. When a company purchases a long-term asset, it has to sit down to determine what its estimated useful life will be. There are certain IRS guidelines as to what is permissible, but there is some flexibility. For example, if Jackie wanted to purchase a forklift for her hardware store for $70,000, and she establishes that the forklift has an estimated useful life of 7 years, she is permitted to expense 1/7 of the cost of that forklift against earnings for each of the next 7 years. At the end of 7 years, the forklift still works and she still could sell it for something greater than zero. However, she has already expensed the full amount of the forklift. So she carries it on her books now at zero, and yet it still retains some value, possibly $8,000. That's one example as to why market value may differ from book value. This non-cash expense of $10,000 a year is called depreciation. The non-cash expense associated with the gradual loss of value of an intangible asset is called amortization. For simplicity's sake, when we talked about the income statement earlier, we did not discuss the implications that depreciation would have had on her financial statements. Had we done so, it might have looked something along the following lines. Jackie had $1.1 million of real estate and related improvements listed as a long-term asset on her balance sheet at the end of last year. Of this amount, $140,000 was attributable to land, which is not permitted to be depreciated as it is not viewed to deteriorate in value over time. If we had depreciated the remaining $960,000 of her building and related improvements over, for the purposes of this example, 30 years, she would have had approximately $32,000 a year of a non-cash expense called depreciation attributable to the gradual loss of value on the building over that time. In addition, she would have established, for example, a 5-year estimated useful life on her furniture, equipment, fixtures, and so forth. The furniture, equipment, and fixtures had a book value of $400,000, and using the straight line method, meaning that 1/5 of the value is expensed through depreciation each year, she would have had an $80,000 non-cash expense associated with the gradual loss of value or depreciation of the furniture, equipment, and fixtures. Adding the $32,000 of depreciation on the building, the $80,000 of depreciation on her furniture, fixtures, and equipment, she would have had total depreciation last year of about $112,000. But $112,000 exceeded her pre-tax income. In effect, this depreciation expense would have caused her to lose money, which, oddly enough, increases her cash because no longer does she have to pay the $33,000 in income taxes, and her cash balance would increase by this amount. So accelerating depreciation from a small business owner's perspective is very common in order to increase cash. Repairs versus improvements. If Jackie is replacing a pane of glass in the building in which her hardware store resides, would that cost be considered an expense because the value is lost, or would it be considered an improvement and therefore added to the asset, which is her building and improvement? The answer is it depends. It depends on whether or not her son threw a baseball through the window and she's basically fixing and bringing it back to where it was, or whether she's installing new, fancy, double-pane, energy-efficient windows and improving the value of the building. There is some gray area here as to whether such expense should be allocated as a repair and expensed immediately or as an improvement, which means you would capitalize or add the cost to that improvement to the asset and depreciate it over time, which brings us to expensing versus capitalizing. As we mentioned, there is a gray area as to what expenditure should be expensed immediately and what expenditure should be added to the value of an asset and expensed over time. But from time to time, there is a dramatic reason as to why the value of an asset drops. Let's imagine that Bristol Myers is developing a cancer drug, capitalizing the research and development costs onto the balance sheet as a long-term asset. After going to the Food and Drug Administration, however, for testing, the drug is found to cause cancer. Bristol Myers would then have to recognize that all of the money invested in development is now nothing more than excess value on the balance sheet. Also, if you're holding a receivable from a customer that files for bankruptcy, the likelihood is that you're never going to get paid. So at that time, you may consider the asset you hold in your balance sheet overstated. In addition, if you hold antiquated inventory, like a shelf full of 8-track tapes, it is unlikely that you are ever going to sell them for your cost. So whenever there is a dramatic difference between the real market value of an asset and the carrying value or book value on your financial statements, a more appropriate asset value should be established, and any excess value listed on your balance sheet should be expensed. The purging of said excess carrying value is called a write-down. And when you write down an asset to zero, that is considered a write-off. Review. Number 1, cash-based accounting recognizes receivables. The answer is B, false.
False.
2, assets are originally listed on the balance sheet at their cost. The answer is A, true.
True.
3, depreciation is the way to account for the gradual loss of value of a tangible asset. The answer is A, true. You may have heard the acronym EBITDA. EBITDA stands for Earnings Before Interest, Taxes, Depreciation, and Amortization, and is loosely referred to as cash flow. EBITDA is generally viewed as a barometer as to how much debt a company can afford to pay. Basically, it's how much money that company is generating, excluding such things as changes in asset values and excluding the necessity to replace some of the equipment that is being depreciated. Many securities analysts on Wall Street like to use it to determine what a company might be worth. Determining company value is important in considering investments. Very often, companies look to make investments. Those investments often include purchasing other companies. When evaluating a potential purchase, companies look at criteria such as, is there a need for the product or service this company provides? If they're currently only selling in New York, and they might be also able to sell in California too, that's a growth opportunity. What is the competitive landscape? Are there low barriers to entry? If they're selling only to the medical field and they could also sell to the technology field, that's another growth opportunity. Are there potential cost reductions? Will there be a need to replace equipment? Is the building in good shape or will I have to do a major rehab? And what kind of revenue and profit can I generate next year and the following year and so forth? And how does that compare to the kind of money that I have to put up now in order to get to that potential revenue and profit stream? Looking at an example, Jackie was offered the opportunity to buy a company which has developed a patch for concrete but is yet to reach commercial acceptance. She can buy the company for $100,000 and expects to spend an additional $100,000 to bring the product to commercial acceptance before she can start selling it and deriving revenue. So her total initial investment is $200,000. If her expectations are met, she believes that in 4 years she can generate revenue from that company of $1 million a year and corresponding profits of $250,000 a year. In her mind, that would apply a value of $1 million 5 years from now. The product seems to fit a niche, there's no real competition, they have patent protection, but she's got limited resources. She can take this money and buy inventory in bulk and get her hammers cheaper, increasing her gross margin. She also has to consider whether or not the $100,000 is sufficient to get the product to commercial acceptance. There's a real risk that she buys the company for $100,000, spends another $100,000 unsuccessfully, and then realizes she needs to spend more, hopefully, to get to commercial acceptance. She could be put into a position at that point. Do I dip into my pocket for more money, or do I write off the $200,000 that I have capitalized into my business? As a result of this substantial risk and illiquid nature of this opportunity, she ascribes a 40% minimum rate of return or hurdle rate to this investment. It may seem high, but under the circumstances, it's quite reasonable. So the question is, if she thinks it would be worth $1 million 5 years from now, and she needs to get a 40% return to compensate for her risk, what would the investment be worth today, and is it more or less than $200,000? In other words, what is the investment's net present value? Well, the answer is if she took $185,000 today and it returned 40% annually for 5 years, it would reach the $1 million mark. But she's having to pay $200,000. She's having to pay more than the net present value of the investment. In addition to the fact that she's got other pressing uses for the money, this is not an attractive opportunity for her, and she should therefore pass. There are two types of investors, financial investors and strategic investors. Both seek to get more money in the future than they invest today. Financial investors include hedge funds, pension funds, and individuals. Strategic investors, such as vendors, competitors, and suppliers, they have other advantages that make strategic investors better buyers. For example, a large supermarket chain and a financial investor might both be looking at buying a local supermarket. The financial investor looks at the supermarket and says, okay, it's currently generating revenues of X and profits of Y, and I can get a Z rate of return. The strategic investor, however, looks at the local supermarket and says, you know, they have their own accounting department. We can easily consolidate that accounting department into our own and save 2 salaries. We can also use our large purchasing power and lower the cost of inventory because we buy in bigger bulk. We also have an advertising campaign already covering that area, so that expense disappears. Lastly, we're taking a competitor out of the market, so we no longer have to compete with them, and we may be able to raise prices. So for all of these reasons, a strategic investor is a much more attractive buyer because they can afford to pay more and still achieve a superior rate of return. When evaluating investments, public companies must determine whether or not they are sound for their shareholders. If you, for example, own 10% of a company that earns $1 million a year, you want your share, or $100,000 per year, to grow. If the company enters into a transaction whereby your share increases to $125,000 annually, you'll be very happy. Conversely, if they enter into a transaction whereby your income declines to $75,000, you won't be quite so thrilled. When earnings per share go up as a result of a transaction, that transaction would be considered accretive. When earnings per share decline as a result of a transaction, that transaction would be considered dilutive. Companies can use cash, debt, or equity to make these acquisitions. When you make acquisitions with cash or debt, you're losing interest income on the cash. You're also obligating yourself to pay cash in the future through the repayment of debt. You no longer have that cash cushion. So the question is using stock a prudent means of carrying out such an acquisition? And the answer depends on whether or not the transaction increases or decreases earnings per share. For example, a public company called XYZ Corporation has $1 million in annual earnings and 1 million shares outstanding, and therefore has $1 per share in earnings. That's $1 million in earnings divided by 1 million shares. It trades at $20 per share and therefore has a market capitalization of $20 million. That's 1 million shares times the value of each share, $20. ABC Corporation, which is a private company, is for sale for $10 million. ABC also earns $1 million per year. XYZ agrees to acquire ABC for 500,000 shares of XYZ stock. 500,000 shares at $20 per share equals $10 million. After the transaction, XYZ will have 1.5 million shares outstanding, the original 1 million plus the additional 500,000 they issued to the ABC shareholders as payment for their company. But now they are earning $2 million a year. $2 million divided by the 1.5 million shares outstanding equals $1.33 per share. So each share of the company has just had its income increased by 1/3. Clearly, that transaction is accretive and very desirable. The same analysis can be conducted for any internal project, acquisition, or anything that requires company resources, because all companies have limited resources. Whether you're a local laundromat owner evaluating using $1,000 to buy a new dryer or a vending machine, or General Electric considering buying Telemundo for NBC, or developing a new healthcare technology, or putting a power plant on a barge off the coast of Nigeria, you have to make choices. In order to make these choices most effectively, you need to lay out what your options are and budget accordingly. All companies have limited resources, and management is evaluated on how well they make these decisions. Management is evaluated on the return on assets that they derive. You have these assets to work with. What can you do with them for the benefit of shareholders? Investments are not meant to be held forever. They are meant to be liquidated at some point in the future. Whether you're an individual holding stocks or a company buying another company, at some point you're looking to get more money back. That money can come in the form of dividends, an outright sale of the company that you purchased, or as many of you know, there is an opportunity to sell a portion of the company to allow that company to become tradable on an exchange through your broker. Such a transaction is commonly referred to as an IPO, or initial public offering. Lastly, I'd like to take a couple of minutes and talk about how some accounting issues at major companies relate to topics that we talked about today, starting with Xerox. Xerox, as you know, is a company that makes copiers and similar products. In recent years, Xerox almost filed for bankruptcy because of some problems related to accounting. They had several of their subsidiaries whose managers were motivated by short-term profits. Possible bonuses led them to take some very aggressive positions on how they recognized revenue. For example, if they received a 5-year contract to maintain a copier at $10,000 a year, they would have recorded the entire $50,000 in the first year. Most of the expenses, however, associated with these contracts increase towards the end as the copiers grow older. So this overstatement of revenue caused their Mexican subsidiary to look extremely profitable, and the managers were handsomely compensated. But over the next few years, they had no revenue to report while expenses grew. Things blew up for them, but luckily they were able to turn the corner prior to filing for bankruptcy. We all know about Enron. Enron, in a very unscrupulous and unethical manner, hid debt in partnerships offshore. These partnerships were controlled by officers of Enron. These partnerships incurred a tremendous amount of debt that Enron guaranteed, but Enron did not recognize any such obligation on its balance sheet. In addition, these partnerships had transactions with Enron which inflated Enron's revenue without appropriate associated costs. So for these reasons, Enron was able to look like it had very little debt on its balance sheet while having substantial additional revenue. Once investors and analysts started peeling the proverbial onion, the house of cards quickly fell apart, and more than $100 billion of market value evaporated with the collapse of Enron. Bernie Ebbers of WorldCom gave testimony as to why he believed that the accounting improprieties of WorldCom were not his fault. He was the president of the company, but claimed to have no knowledge of the fact that they took roughly $11 billion of expensible costs and capitalized them. instead of appropriately recognizing that there was a loss of value, that the value was being purged and should have been expensed, they capitalized those expenditures as assets. Instead of having substantial losses, it looked like all this money that they were spending was adding value. So their assets looked huge and their expenses minimal. They were labeling these expenses as an investment in their technology and infrastructure. So once that unraveled and the company effectively ran out of money, they filed for bankruptcy and Bernie was sent to prison. To summarize the two principal financial statements which describe a company's financial position, the income statement starts with revenue, the money that you bring in before you pay any expenses. From revenue, we pay our direct costs, those items directly involved in the generation of revenue, such as commissions or cost of goods that are sold. The difference between revenue and direct cost is gross profit. Gross profit, less your operating expenses, which are costs that are incurred regardless of revenue generation, leads you to operating profit. From operating profit, you pay such non-operating expenses as interest and taxes, leaving you with net income. The income statement always governs a period of time, generally a year. The balance sheet asks, at the end of last year, what did you own, what did you owe, and what was left over? Assets always equal liabilities plus net worth. It's important that you remember this example. The purchase of a $100,000 house with a $90,000 mortgage and a $10,000 deposit illustrates the balance sheet. The $100,000 asset, the house, equals the $90,000 liability, the mortgage, plus the $10,000 down payment, the equity or net worth. The balance sheet is a snapshot of a specific point in time. You should have a much better understanding of accounting in general and financial statements in particular. If you work for a public company or own shares in a company, you should get a copy of their annual report and check out the income statement and balance sheet. Test your knowledge. And if you have any questions, go to your finance department for help or clarification. Congress passed an act in 2002 called the Sarbanes-Oxley Act in response to the financial scandals we discussed a moment ago. The reason you're taking this course may be in part because of the Sarbanes-Oxley Act, which demands that public companies be held accountable for accurate financial reporting. We all have a stake in being certain that our money is secure and that the people who manage it are held accountable. Hopefully this course has given you the tools to make you part of the process. And that's Accounting in an Hour. Please feel free to contact us as shown. An interactive online version of this program is available at accountinginanhour.com, which enables individual and collective tracking of financial literacy improvement. Thank you very much for your time. We'll now field any questions.
Wow, Rick, that was unbelievable. That was a feat.
Well, thank you very much. That's very kind.
Excellent performance, excellent job, such incredible grasp of information and knowledge, and done expertly. Just terrific.
Well, that's very kind.
And ladies and gentlemen, we're going to open up to questions now from the audience. Who'd like to begin? Also on the Q&A bar in the top of your screen, you can add a question. You can also engage in discussion. Hold on one sec, Rick. Make sure we have the lines open. Hey, ladies and gentlemen, can you hear us out there?
Yes.
Great. Any questions from the audience? Any reflections, questions, thoughts?
I thought it was great. I don't have any questions.
Great.
Well, thank you very much. Again, we're very grateful for you taking the time to hear us out today. And again, should you wish to contact us in the future, you can get us at any time at accountinginanhour.com. And thanks again for taking out your time in this very scarce time environment.
Absolutely. Rick, thank you very much. Terrific stuff. Rick, from Chief Executive Officer of In an Hour, 1-800-556-6799, and Rick at inanhour.com, or his website, www.accountinginanhour.com. Thank you very much, Rick. It's a pleasure.
My pleasure. Thanks to the